Silver price, maybe unstoppable. Is $100 the new bottom? In Dubai right now, physical silver is trading at $127 per ounce. In New York, the paper price shows $73. That's a 74% disconnect. But here's what nobody's talking about. China just banned silver exports. India's government set a price floor at $100. And the largest institutional buyers, they're not selling, they're accumulating. While mainstream media stays silent, something unprecedented is unfolding in the precious metals market. And if you're holding dollars right now, what happens next could change everything. Welcome to Currency Archive. You know, I've noticed something about folks who've been around long enough to see a few market cycles. They don't rush to subscribe to just any channel. They watch, they evaluate, they decide if the information is worth their time. So here's what I'll say. If this analysis makes sense to you, if you value unfiltered market intelligence without the sensationalism, hit that subscribe button. And do me a favor, drop a comment below and tell me where you're watching from today. Are you in the States, Canada, UK, Australia? I'm curious to know where this message is reaching people who still remember when a dollar actually meant something. Now, let's talk about what's really happening with silver. Something unusual is happening in the silver market right now, and most investors have no idea it's taking place. In Dubai, physical silver is changing hands at $126 per ounce. In New York, the COMEX exchange shows silver trading at $73. That's not a minor difference. That's a 74% price gap between the same metal in the same world at the same time. Financial analysts don't talk about it. Mainstream business channels don't cover it. And yet, this disconnect is growing wider every single week. When professional traders see a price gap like this, they call it an arbitrage opportunity. Buy low in one market, sell high in another, pocket the difference. Simple economics. But here's the problem nobody wants to address. That arbitrage isn't happening. The gap isn't closing. And the institutional players who normally jump on these opportunities, they're staying quiet. Because they understand something the public markets haven't priced in yet. This isn't a temporary inefficiency. This is a structural breakdown in how silver gets priced globally. For decades, the price of silver has been determined by futures contracts on exchanges like COMEX, paper contracts, financial instruments that represent silver but aren't actually silver. These contracts trade in massive volumes. Hundreds of millions of ounces change hands electronically every single day. But here's what matters. Only a tiny fraction of those contracts ever result in physical delivery. Most traders never want the actual metal. They want price exposure, they want leverage, they want to speculate on price movements without dealing with storage, insurance, and logistics. And for years, this system worked. The paper price and the physical price stayed relatively aligned. Close enough that the market accepted COMEX as the global price benchmark. But that alignment is breaking down. In physical markets across the Middle East and Asia, silver dealers are refusing to sell at COMEX prices. They're not being difficult. They're being realistic. When a dealer in Dubai gets a request for 1,000 ounces of physical silver, he knows what it actually costs to acquire that metal. He knows the premiums. He knows the shipping costs. He knows the scarcity. And he knows that 73 per ounce does not reflect the reality of securing physical silver in today's market. So he quotes $100, $115, sometimes $127, and buyers are paying it because they need the actual metal, not a contract, not a promise, not a derivative, the physical product. This creates a serious question for anyone holding wealth in traditional financial assets. If paper markets say silver is worth $73, but physical markets won't sell below $100, which price is real? The answer matters more than most people realize, because silver isn't just an investment metal like gold, it's an industrial metal. Solar panels need it. Electronics manufacturing needs it. Defense systems need it. Electric vehicle production needs it. These industries can't function with paper contracts. They need physical delivery. And they're discovering that physical delivery comes at a very different price than what financial markets suggest. Now, some analysts argue this is just a temporary supply chain issue. They say premiums are high because of logistics problems, shipping delays, refinery bottlenecks, temporary inefficiencies that will resolve themselves. But the data tells a different story. COMEX silver inventories have dropped 40% over the past 18 months. Registered silver, the metal actually available for delivery, is at multi-year lows. Meanwhile, vault storage facilities in Singapore, Switzerland, and the UAE are expanding capacity. Private storage demand is surging, and the entities moving metal into private storage, they're not retail investors panicking about inflation. They're institutions, sovereign wealth funds, family offices managing generational wealth, the kind of players who don't make emotional decisions. They make strategic ones. So when these sophisticated entities are willing to pay $100+ for physical silver, while paper markets trade at $73, What do they know that public markets haven't figured out yet? That's the question business leaders need to be asking right now. Because if $100 becomes the new baseline for physical silver, if that price floor holds regardless of what COMEX says, then everyone holding dollar-denominated assets needs to understand what comes next. The implications go far beyond precious metals markets. This affects currency valuations. It affects industrial supply chains. It affects strategic resource allocation for any business with significant dollar exposure. And the window to prepare may be shorter than most decision makers realize, because while financial media focuses on stock market movements and interest rate decisions, a fundamental restructuring of commodity markets is happening in real time, quietly, methodically, and with consequences that haven't fully materialized yet. The $100 floor isn't speculation anymore. For those actually buying physical metal, it's already reality. The only question left is how long paper markets can maintain the illusion that it isn't. On November 12, 2024, a policy document appeared on China's Ministry of Commerce website. 12 pages. Dense bureaucratic language, buried in Section 4.7, a single paragraph about silver export protocols. Most Western analysts ignored it. Those who noticed it filed it away as routine trade administration. But in private vaults across Hong Kong and Singapore, that paragraph triggered immediate action, because sophisticated players understood what it actually meant. China had just weaponized silver. The document didn't use dramatic language. It didn't announce a ban. It simply stated that silver exports now required special licensing approval through a newly created review committee. Applications would be processed within 90 to 120 days. Approvals would be granted based on strategic national interest considerations. On the surface, administrative procedure; in practice, a complete choke point on Chinese silver leaving the country, and China controls approximately 18% of global silver mine production. More importantly, China controls over 40% of global silver refining capacity. That's the number that matters, because raw silver from mines in Peru, Mexico, or Australia often gets shipped to Chinese refineries for processing. Now, that refined silver isn't leaving China. The metal goes in. The metal doesn't come out. This isn't China's first move in the strategic metals playbook. In 2010, China restricted rare earth element exports. The world depended on Chinese rare earths for everything from smartphone screens to missile guidance systems. When China tightened supply, prices exploded. Neodymium increased 900% in 18 months. Dysprosium jumped 2,000%. Western nations scrambled to develop alternative supply chains. It took them nearly a decade. And rare earths are specialty metals with limited applications. Silver is embedded in thousands of industrial processes across every major economy. The scale of disruption is exponentially larger. But China isn't acting alone in this strategic shift. India made its own quiet move 3 months earlier. The Indian government, through its state-controlled Precious Metals Corporation, established a price floor mechanism, not for futures contracts, for physical metal purchases. The floor? $100 per ounce. Any domestic silver dealers selling below that price would lose their operating license. Any import transaction below that price would face enhanced regulatory scrutiny. Again, no dramatic announcement, no press conference, just a regulatory framework that fundamentally changed the pricing structure for the world's second largest silver consumer. Now, some observers might see these as isolated national policies, unrelated decisions by different governments pursuing different objectives, but when mapped against Middle Eastern sovereign wealth fund activity, a pattern emerges. In the past 16 months, vault storage capacity in Abu Dhabi has increased by 340%. Kuwait's sovereign fund moved $2.8 billion into physical precious metals, with silver allocations tripling. Saudi Arabia's public investment fund established new custody relationships with Swiss vault operators. These aren't retail investors reading blog posts about inflation. These are nation-states with trillion-dollar portfolios, moving real capital into physical metal. And they're not buying at COMEX prices. They're paying the physical premium. They're accepting the 100-plus price point because they're not trading. They're accumulating strategic reserves. The question serious analysts are asking now is simple. Why? Why would nations simultaneously start treating silver like a strategic resource instead of a commodity? The answer lies in what's happening beneath the surface of global manufacturing. Solar panel production is projected to double by 2027. Each panel requires approximately 20 grams of silver. There's no viable substitute that maintains efficiency standards. Electric vehicle production is scaling faster than anyone predicted 3 years ago. Each EV uses 25 to 50 grams of silver in electrical contacts and components. Defense systems, satellite technology, 5G infrastructure, medical equipment. Every major technological advancement in the next decade is silver intensive. And the nations who control silver supply control critical infrastructure development. This is where the $100 floor stops being about investment returns and starts being about geopolitical positioning. China understands that controlling silver refining gives them leverage over Western technology supply chains. India understands that establishing domestic price floors protects their industrial base from artificial price suppression. Middle Eastern sovereigns understand that physical metal holdings can't be sanctioned, frozen, or devalued by monetary policy decisions they don't control. These aren't speculative bets. These are strategic chess moves on a board most investors don't even know exists. When rare earth prices exploded in 2010, Western governments promised to diversify supply chains. They promised new mines, new refining capacity, strategic independence. 14 years later, China still controls 70% of rare earth processing. Because building mines takes capital, building refining infrastructure takes time, and markets have short attention spans. Now the same dynamic is unfolding with silver, except this time, the scale is larger, the timeline is compressed, and the price floor is already being set by the physical market. While paper contracts in New York still trade at $70, the actual metal that industries need to function is being priced and controlled by very different rules. And the entities setting those rules aren't talking about it. They're just buying, quietly, strategically, and with full understanding of what comes next when physical scarcity meets derivative exposure. In March 2024, a peculiar transaction occurred in Zurich. A private vault facility expanded its silver storage capacity by 12,000 square meters. Construction completed in 8 weeks. Premium rates paid for expedited permitting. The client who requested the expansion? Undisclosed. But the vault operator let one detail slip during an industry conference. The new space was filled within 72 hours of completion. That's roughly 15 million ounces of physical silver. Moved into private storage in 3 days at current market prices. Approximately $1.1 billion worth of metal. And nobody heard about it. No press release, no SEC filing, no public disclosure of any kind, because the entity moving that metal had no obligation to tell anyone. This is how institutional accumulation actually works. It doesn't happen on CNBC, it doesn't show up in quarterly earnings calls, it happens in private transactions between parties who benefit from silence, and it's happening at a scale that public data completely misses. The challenge for independent analysts is simple. How do you track metal movements that nobody reports? How do you measure accumulation that deliberately avoids detection? The answer lies in studying the infrastructure, not the transactions themselves. Vault operators don't expand capacity for fun. Construction costs in Switzerland run $4,000 per square meter for secure precious metal storage. That's $48 million for the Zurich facility alone. Nobody spends that capital unless they have confirmed demand. Long-term contracts, committed clients, guaranteed utilization. And over the past 18 months, vault capacity has expanded in 5 key jurisdictions. Switzerland, obviously. Singapore increased private vault space by 28% since January 2024. Dubai added 4 new free zone vault facilities. The Cayman Islands, quietly, tripled its precious metals storage infrastructure. And London, despite publicly reported declining silver ETF holdings, saw private vault utilization increase to 94% capacity. These aren't coincidences. These are symptoms of institutional repositioning. Now contrast that with what's happening in the ETF market. The largest silver ETFs have seen net outflows of approximately 89 million ounces since mid-2023. Financial media reports this as bearish sentiment, retail investors losing confidence, smart money exiting the trade. But here's what those headlines miss. ETF silver isn't disappearing, it's transferring. When shares are redeemed, metal backing those shares gets sold. But sold to whom? The ETF doesn't publish buyer information. The bullion banks facilitating the transaction don't disclose client names. But the metal goes somewhere. And given the vault expansion data, it's going into private hands. Entities who prefer direct ownership over fund shares, control over convenience, physical possession over paper promises. There's a specific profile emerging in this accumulation pattern. Family offices managing generational wealth, sovereign entities with long-time horizons, insurance companies rebalancing reserve assets, pension funds adding non-correlated hard assets. These aren't traders. These are institutions that think in decades, not quarters. And they're not buying silver for 15% returns. They're buying it because they've modeled scenarios where paper-based financial assets face systemic stress. Scenarios where physical commodities become monetary alternatives. Scenarios where supply chain control matters more than yield optimization. One European family office, managing $18 billion in assets, published an internal memo in late 2023. The memo never reached public circulation, but a former employee shared excerpts with a commodities research firm. The key passage read, "Our allocation to physical silver is not a trade. It is insurance against monetary architecture failure. The position is sized for multi-generational hold periods and will not be liquidated based on price movements. That's not speculative positioning, that's strategic asset preservation. And the volume being moved suggests this mindset is widespread among institutional capital." Central banks provide another data point. Official gold reserves get reported. Silver reserves don't. There's no international requirement for central banks to disclose silver holdings, but shipping manifests tell a different story. In 2023, over 47 million ounces of silver moved through customs into central bank custody accounts. These shipments were flagged as monetary reserve transfers, not commodity purchases, not industrial supply, monetary reserves. That classification matters because it means central banks are treating silver as money, not just metal, and they're doing it without telling their citizens or financial markets. Perhaps the most telling indicator is what's happening with derivative positioning. The major bullion banks, the entities that facilitate COMEX trading, are quietly reducing their short positions. In January 2023, total commercial short interest in COMEX silver sat at 412 million ounces. By December 2024, that number dropped to 187 million ounces, a 55% reduction. These banks aren't covering shorts because they suddenly became silver bulls. They're covering because they've modeled the risk of a delivery squeeze. They understand what happens when paper contracts demand physical settlement and physical metal isn't available at listed prices. They remember what happened to nickel on the London Metal Exchange in March 2022. Prices went vertical, trading halted, contracts got canceled, billions in losses, regulatory chaos. The banks learned from that. And they're reducing exposure before silver creates the same problem. So while mainstream financial media focuses on ETF outflows and COMEX price action, the sophisticated money is doing something completely different. They're moving metal into private storage. They're establishing long-term physical positions. They're treating $100 oscillars not as a ceiling, but as a baseline assumption. And they're doing it quietly because the last thing institutional accumulation wants is attention. Attention creates competition. Competition drives prices higher. Higher prices reduce position size for the same capital deployment. So the accumulation continues in silence, in private vaults, through undisclosed transactions, while public markets trade paper contracts that increasingly represent nothing but promises. And promises only matter when the entity making them can actually deliver. In August 1971, President Nixon closed the gold window. Dollars could no longer be redeemed for gold at $35 per ounce. Most Americans didn't understand what that meant. Financial analysts called it a temporary suspension. Economists debated the technical implications. But the strategic players, the ones who understood monetary history, they acted immediately. Within 6 months, gold went from $35 to $120, not because gold changed, because the dollar did. The anchor disappeared, and 53 years later, another anchor is being tested. Here's what most people miss about the silver situation. This isn't really about silver. It's about what silver pricing reveals about dollar-based markets. For decades, the dollar served as the global pricing mechanism for commodities. Oil priced in dollars, copper priced in dollars. Gold, silver, platinum, all priced in dollars. This created enormous structural demand for dollar holdings. If you needed commodities, you needed dollars first. That demand allowed the United States to run deficits that would collapse other currencies. The system worked. What stops oil producers from saying, NYMEX prices don't reflect our costs, we're adding a physical premium? The precedent is being set right now, in real time, and most dollar holders have no idea it's happening. This creates a specific risk profile for businesses and investors holding dollar-denominated assets. Cash feels safe. Treasury bonds feel secure. Dollar-based portfolios feel liquid. But that safety assumes the dollar maintains its purchasing power for real assets. And if commodity markets are repricing away from dollar benchmarks, that assumption needs serious reconsideration. Consider a manufacturing company with $50 million in cash reserves. That cash is meant to cover 6 months of operating expenses, raw materials, components, payroll. But if the physical price of critical inputs diverges 50%, 70%, 100% from listed prices, that $50 million doesn't cover 6 months anymore. It covers 3 months, maybe 2. The dollar number didn't change. Its purchasing power did. In the 1970s, the gap between official gold prices and black market prices persisted for nearly 3 years before official markets capitulated. In 2010, rare earth prices took 18 months to fully adjust after China restricted exports. But both those situations involved smaller markets with less systemic importance. Silver sits at the intersection of monetary metals and industrial necessity. The adjustment timeline could be faster, or it could be more violent. 3 scenarios emerge from current data. Scenario 1, convergence upward. Paper markets eventually accept physical reality. COMEX prices rise to meet Dubai prices. The $100 floor becomes the official floor. Dollar holders see commodity costs increase 40-80% across industrial metals. Inflation metrics spike. Central banks face impossible policy choices. This scenario is orderly, but painful for dollar-heavy portfolios. Scenario 2, market bifurcation paper and physical markets permanently separate. Financial traders continue trading contracts at $73. Industrial buyers pay $100 for actual metal. Two parallel pricing systems emerge. Derivatives become increasingly disconnected from underlying assets. This scenario is unstable and eventually breaks one way or another. Scenario 3, delivery squeeze. A major contract holder demands physical delivery. COMEX can't source metal at listed prices. Exchange halts trading or forces cash settlement. Confidence in paper precious metals collapses. Prices spike violently as markets reprice decades of derivative exposure. This scenario is chaotic, unprecedented by the London nickel situation. For treasury managers, capital allocators, business owners holding significant dollar positions, the strategic question isn't whether to act, it's what percentage of assets warrant protection. Traditional portfolio theory suggests 5 and possibly 10% in hard assets. But traditional portfolio theory assumed functional price discovery. It assumed paper and physical markets stayed aligned. It assumed that dollar's role as commodity pricing mechanism remained unchallenged. Those assumptions are being tested right now, and the entities with the most to lose, the sovereign wealth funds, the family offices, the institutional players, they're not waiting for certainty. They're repositioning while physical metal is still available. They're accepting the $100 price point. They're moving assets out of paper promises and into tangible reserves. Not because they're panicking, because they've modeled what comes next if they're right. And they've decided the cost of being wrong is higher than the cost of being early. The $100 floor isn't a prediction anymore. For anyone actually transacting in physical silver, it's already here. The only question remaining is how long financial markets can pretend it isn't, and what happens to dollar-denominated wealth when that pretense ends.